Self-storage seems like the perfect investment. Tenants pay rent, you collect checks, barely any work, right? Not even close. I'm going to show you the 5 things nobody tells you before they buy their first facility: the hidden costs, the zoning traps, the tenant nightmares, the saturation problem eating the industry from the inside. And by the end, you'll know exactly whether this business is actually for you or whether it's just a very well-marketed illusion. You'll know the real startup costs, not the glossy broker numbers designed to get you to sign. You'll learn what zoning laws can do to kill a deal overnight after you've already spent money you can't get back. And most importantly, you'll walk away with a checklist to vet any facility before you touch your capital. Let's go. Most brokers will tell you a self-storage facility costs between $500,000 and $2 million to acquire. What they don't mention, that's just the down payment conversation. The real number, the one that actually gets a facility fully operational and stable, is often double what the listing price implies once every real cost is on the table. You need insurance, permits, legal fees, and working capital reserves before you can call this business running. Insurance alone can run $8,000 to $15,000 a year, and that number climbs fast if your facility includes climate-controlled units, which now make up roughly 40% of self-storage space nationally as the industry has shifted upmarket. Permits vary wildly by state and municipality, anywhere from $5,000 to $25,000 depending on local requirements. Then there's the facility manager's salary, landscaping, ongoing repairs, and a vacancy buffer that has to sit there whether you're using it or not. Most successful operators keep 6 months of operating expenses in reserve, and the more disciplined ones push that to 12. If your annual operating costs run $50,000, that means $25,000 sitting untouched in a bank account at all times, doing nothing but existing as a safety net. That money isn't compounding. It isn't generating a return. It's just there. For a business that's marketed as low effort, high return, the amount of dead capital required to operate it responsibly is one of the first surprises that catches new investors off guard. And here's context that matters. The industry's total asset value in the US sits around $100 billion, generating over $50 billion in annual revenue, the number achieved by professionally run operations with economies of scale, not the number a first-time solo buyer should expect walking in. Here's where dreams die. Zoning. You find a property, the price is right. The broker says, this location is perfect for storage. But have you checked the actual zoning code? Not what the broker told you, the actual municipal code. Most residential and commercial zones explicitly prohibit self-storage facilities outright. Some jurisdictions only permit them in industrial zones. Others require a conditional use permit, which means your neighbors get a formal say in whether your facility gets built, and they will show up to that hearing. They will object loudly, and local zoning boards listen to angry residents far more than they listen to out-of-town investors. Investors have spent anywhere from $10,000 to $40,000 on legal fees, fighting zoning objections, and lost anyway. The municipality says no. The deal is dead, the money is gone, and there's no refund line item for "we tried." Then there's the environmental review most first-time buyers never think to ask about: soil contamination, flood zone designation, previous industrial use on the site. Depending on the property's history, you may be required to complete a Phase 1 or Phase 2 environmental assessment before you can even break ground or finalize financing. That's another $3,000 to $15,000 out of pocket. And if the assessment finds contamination, you may not be able to build on the site at all, regardless of how much you've already spent getting to that point. This is the part of the self-storage pitch that never makes it into the glossy investment brochure. The zoning and environmental risk sits entirely on the buyer, and it can materialize after you've already committed real capital, not before. You've cleared zoning, permits approved, units are rented. Now comes the real work: tenants. Self-storage attracts a specific demographic, and it's worth being honest about it. People in transition, divorces, job losses, downsizing, evictions from their own homes. These are often your most financially strained renters, and financial strain means higher default rates than almost any other real estate asset class. Industry averages put default rates somewhere around 5% to 8% of tenants who simply stop paying. That's roughly 1 in every 12 units generating zero revenue while still costing you money to maintain. When a tenant stops paying, you can't just show up and lock them out. Lien laws vary significantly by state. In some states, you need a formal court order before you can act. In others, you're permitted to auction their goods, but only after a mandatory waiting period, typically 30 to 90 days of missed rent. During that entire window, you're still paying insurance and maintenance on that unit while collecting nothing. And here's the brutal part: almost nobody explains ahead of time. Auctioned goods rarely cover the back rent owed. A unit full of someone's life possessions might sell for $200 at a public storage auction, while the tenant owed you $800 in unpaid rent. You eat that loss every time. Then there's turnover, which is its own recurring drain. A tenant moves out, and you need to clean, repair, repaint, and remarket that unit before it generates revenue again. Turnover typically costs 15% to 25% of 1 month's rent per unit. On a unit renting for $100 a month, that's $15 to $25 lost every single time someone leaves. A small number per unit, but multiply that across a 400-unit facility with normal churn, and it becomes a real, recurring operating cost that eats into margin month after month. Self-storage looks like a goldmine, so everyone is building one. Over the past decade, self-storage became one of the fastest-growing sectors in commercial real estate, and new facilities have opened in almost every major and mid-size market across the country. That's great if you got in early, before the land grab. If you're buying in now, in 2026, you're typically competing against established operators, often REITs with better pricing power, stronger brand recognition, and far deeper cash reserves than any individual investor. And the scale gap here isn't small. More than 37% of all self-storage space in the US is now controlled by just 5 firms, 4 of which are REITs: Extra Space Storage, Public Storage, CubeSmart, and National Storage Affiliates Trust, plus U-Haul as the 5th major player. When Extra Space Storage acquired Life Storage in 2023 for roughly $12.7 billion, that wasn't just a big transaction. It was a signal about where the entire industry is consolidating. You are not competing against mom-and-pop operators anymore in most major markets. You're competing against publicly traded companies with institutional capital and pricing algorithms. Here's how that plays out on the ground. A new competitor opens 2 miles away. They offer first month free aggressive move-in specials, climate control at the same price point you're charging for a basic unit. Your occupancy, which might have been sitting comfortably around 85%, can drop into the 70s within a matter of months. And your revenue doesn't just drop proportionally to that occupancy loss, it drops by 25% to 30% because you're forced to start discounting your remaining units just to stay competitive and slow the bleeding. Meanwhile, your mortgage and fixed operating costs stay exactly the same, regardless of how many units are filled. A first-time solo buyer simply doesn't have access to on day one. Suddenly, that 8% return you projected in your initial spreadsheet, current cap rates in the sector actually range from roughly 5% to 7.5%, depending on asset quality and market, and a facility fighting for occupancy against a well-funded new competitor can see that realized return collapse toward 4% or slip into negative territory entirely. The only way to win consistently in an increasingly saturated market is scale, brand, or an exceptional defensible location. If you're a solo operator with a single facility, you are playing a structurally disadvantaged game against institutions that own dozens or hundreds of facilities and can comfortably absorb a bad year at one location. Okay, so self-storage sounds like a nightmare so far, but it's not impossible. The operators who actually succeed in this business share 3 specific traits, and none of them are luck. 1. They buy in genuinely good locations, not okay locations, not up-and-coming locations that a broker is excited about. Actually good locations, high population density, low existing competition, strong underlying demographics, and ideally a market with a tight supply pipeline. Data from Q1 2026 shows that the percentage of facilities facing new competitive supply has actually fallen sharply in high-barrier markets, from the high 20% range during 2021 to 2023 down to around 8% in 2025, which means the operators who identify those genuinely supply-constrained markets right now are positioned very differently than the ones buying into oversaturated Sunbelt metros where years of aggressive development have outpaced real demand. That distinction requires real market research, not trusting a broker's pitch deck. 2. They hold real capital reserves, not just 6 months. The more disciplined, successful operators push toward 12 months of full operating expenses held in reserve. Downturns happen. Tenants default at predictable rates. Repairs cost more than the initial estimate almost every time. Operators with deep reserves survive the rough stretches long enough to reach stability. Operators without them get forced into a distressed sale at exactly the wrong moment. 3. They either operate the facility themselves with real hands-on attention, or they hire a genuinely professional management company and treat that relationship seriously. If you're a passive investor expecting to do essentially nothing after closing, You are already behind before you've even opened. This business requires active oversight, real tenant relationship management, and constant tactical pricing decisions in response to what competitors are doing. You cannot set it and forget it. So yes, you can own a self-storage facility and build real wealth from it, but it is not the passive investment most first-time buyers picture when they see the marketing. It's a genuine, complex operating business wearing a passive income costume. Before you write a check, use this checklist. Every item on it exists because it's the exact thing that's blown up a deal for someone else before you. First, zoning and legal. Call the municipality directly, not the broker. The actual zoning office. Confirm the property is genuinely zoned for self-storage use. Get that confirmation in writing. Ask specifically about conditional use permits, any pending environmental review requirements, and any zoning changes currently under discussion in that jurisdiction. Do not skip this step under any circumstances, even if the broker insists it's a formality. Second, market analysis. Who is your real competition? How many facilities exist within a 5-mile radius, and how many more are currently under construction or in the planning pipeline? What are they charging per unit size? And what's their current occupancy? Call them directly and ask, the way a potential renter would. Most facilities will tell you their availability and pricing over the phone without hesitation. If the local market already looks saturated, or if a large share of nearby supply is still in the conceptual or planning phase, walk away. There will be another deal. Third, the financial reality check. Get a fully detailed operating expense breakdown from the broker or seller. Insurance, property tax, utilities, payroll, ongoing maintenance, everything. Then add 25% on top for the unknowns that always surface after closing. Calculate your actual break-even occupancy rate using real numbers. If you need 75% occupancy just to break even, and the honest market average in that specific submarket is closer to 70%, that's a serious red flag, not a minor concern to work around later. Fourth, your exit strategy. How do you actually sell this facility in 5 to 10 years? Who is the realistic buyer? REITs, other independent operators, or investors like you starting out? Is there genuine demand for a facility of this size and quality in this specific market? Or are you buying something that will be difficult to exit later, even if it performs well while you own it? If you cannot confidently answer all 5 of these before you sign anything, don't buy. The deal will still be there, or a better one will, once you can. If running that checklist kills your deal, you're not out of options. Consider investing in a self-storage REIT instead of buying a physical facility outright. You get real diversification across dozens or hundreds of properties, professional institutional grade management, and genuinely passive income without any of the operational headache. Returns on that path are typically more modest, in the range of 6% to 8% annually, lower than what an exceptionally well-run individual facility can produce in a great year, but with dramatically less risk. Or partner with an experienced operator who already knows a specific market. They handle the day-to-day operations and tenant relationships. You provide the capital. You split the profits according to whatever structure you negotiate. You still get real upside exposure to the asset class, but you're not carrying the operational learning curve entirely alone on your first deal. Or consider a different asset class in commercial real estate entirely: multifamily, industrial, small office. The underlying due diligence principles we just covered apply almost identically across all of them, but some of those markets are meaningfully less saturated right now than self-storage has become in the wake of the pandemic-era investment surge, when construction starts peaked and a wave of new supply hit at once. Development activity has since pulled back, down roughly 21% from the 2023 peak, which is actually a mildly encouraging signal for existing facilities in tighter markets. But it doesn't erase the saturation that already happened in overbuilt Sunbelt metros. Self-storage can be a legitimate wealth-building investment, but it is not the passive, set-it-and-forget-it business most people imagine when they picture a gate code, a fence, and a stack of monthly checks arriving automatically. It requires real capital, genuine market knowledge, active management, and realistic expectations grounded in current numbers, not the pitch you heard from a broker who gets paid whether the deal works out for you or not. If you have all 4 of those things lined up, you can genuinely win in this space, even against the institutional players. If you're missing even one, you are probably going to lose money, slowly, in a way that doesn't announce itself until you're several years and a lot of capital in. So before you ever sit down with a broker, run that checklist and be honest with yourself about whether you're actually willing to run a real hands-on business, because that's what this is, no matter how it's marketed. If you found this breakdown helpful, drop a comment and let me know. I break down real estate and investment opportunities like this every week, and self-storage is just one asset class in a much bigger series. Thanks for watching.